There we go. Okay, let me go ahead and end that poll and share those results with you. But it looks like a lot of people are making pretty good money, at least most, in a W-2 job. You're looking to kind of level up. You want more, your kids, family, freedom, time, all those things that we really cherish and what we're going for. Because at the end of the day, our time is limited, right? The clock is ticking for all of us. We have the same 24 hours in a day. And what are you going to do with them? Is it, sitting in a cubicle job and 9 to 5 and working for the man? Or is it, hey, I'd like to start taking some of that money, putting it into some multifamily apartment buildings? It's a good avenue, but most people are deterred by it mainly because it seems daunting, right? People understand single family because most people either own a home or rent a home so you understand the single family side of it. But you get into the idea of, a 5 unit or a 10 unit or a 20 unit or 100 unit or whatever it is. It's just, you don't understand how the math works, how you find those deals, how you analyze them, how you raise the capital and structure and put it together, how do you close that escrow on the deal, how do you manage it once you own it? All those little avenues that are very, very important, but it is the best route to go. And we're going to kind of walk into that tonight. Okay. Evan, I see you chiming in here tonight saying, I am here to figure out how to buy a C-grade asset, force appreciation through value add, which is what you're talking about, raise the NOI and cash out refi. Beautiful. I'm going to give you a couple examples of it. Case studies that I've done, case studies that some of our students and everybody else has done, and we'll walk you through a few deals on that. Okay. So look forward to that. Beautiful. So why multifamily? I get this question a lot from folks. They're like, hey, I hear about multifamily. I kind of know what it is. Is a 4-unit a multifamily? No and yes. Technically, it's a multifamily, but it still falls under residential real estate, not commercial/multifamily real estate. So anything 1 to 4 units is residential. Anything 5 or more units is technically commercial or multifamily, just so you know. Okay. But why multifamily? Few reasons why it's really, really, really good for you, and why historically it's the best asset class, if not one of the best asset classes to be in. And there's lots of people out there telling you different business models, all cool. Flipping and wholesaling is great. We still do some of the flipping side. Airbnbs, that's a business model. I'm not in it, but some people are doing amazing. There's flex space. You're getting into retail. There's commercial. There's all kinds of avenues of the real estate commercial world. I always say be an inch wide and a mile deep. Right? Know your craft beautifully, be very good at it. I'm a multifamily guy, right? We focus in it. We do mobile home parks as well, but multifamily and mobile home parks, right? I know those extremely well, and we're very good at them, and we've grown an awesome portfolio, and we're continuing to grow further. But why multifamily? You get paid 5 to 8 different ways and times throughout the ownership cycle of the building. Okay, that's number one. 5 to 8 different ways. Many different real estate classes, you get 1 to 3. Multifamily, 5 to 8. I'm going to show you those. Economies of scale. I was chatting with a buddy the other day, and he's like, hey, I own 12 single-family homes in Georgia. And I'm like, okay, that's great. But why the single family? Why didn't you just get a building with 12 units in it? And he says, well, Justin, I don't understand it. Like, I know the single family makes sense, and it seems like safer, and all these other things. I said, well, Jeff, it's actually the complete opposite. Imagine for a moment, your 12 single family homes, you have 12 different roofs, 12 different water heaters, 12 different repair setups, 12 different insurance policies, 12 different yards, 12 different this, 12 different that. If one of your residents moves out of your single family home, you go from 100% occupied to 0 overnight, 100% revenue to 0 overnight. You don't get the economies of scale versus if you had one building with 12 units in it. Right, think about it. One tenant moves out, you're still over 90% occupied and generating 90% revenue and paying the mortgage and paying all the insurance and paying all the bills and paying this and paying that. Economies of scale. Okay. The key is understanding how you would do something like that. Easier to finance. So when you go get a residential loan, anything 1 to 4 units, 9 times out of 10, you're using residential financing. So with that, the lenders are underwriting you personally. They're not underwriting the property. They're underwriting you personally and your ability to pay the mortgage. When you get into multifamily, they're looking at the building and the financials of the property to substantiate you getting the loan. It's less about you, right? You're like secondary in the process. So much easier to finance on multifamily. And then the key kind of tagline word everybody hears is the generational wealth, right? How can I pass this on to family members, kids, anybody out there? How can I do that? Okay. How can I do that? So the generational wealth side. So those are the main reasons for multifamily. So a little bit about kind of my background and story. If you're not familiar with it, my name's Justin Brennan, born and raised San Diego. Grew up, son of a developer guy. My dad, incredible. He learned from my grandmother, who, God bless her soul, was working until she was like 91. And she owned, I want to say like 45 to 50 units in like 2 or 3 different buildings in South San Diego, South Bay San Diego. But they were 100% owned. Like she owned 100% of them. And she would drive around her little S10 truck collecting rent like a little 90-year-old, Italian woman in San Diego for many, many years. So, and then she taught my dad the business. And then my dad got into more development stuff where he was build and sell, build and sell, build and sell. So his income, he'd make a lot of money, but he also lost a lot of money because his income would mimic the real estate cycles. So yes, in 2008, I watched my dad lose it all. I helped him consolidate his businesses. And, I kind of made up my mind at that point, hey, I don't want to be in this build and sell game, right? I want consistency. I want cash flow and cash flowing assets. And so apartments were my avenue. It's not as sexy, right? It's a steady Eddie game, but it's consistent and it's beautiful and you get extremely wealthy because there's many different ways you get paid in multifamily and many different ways to leverage things correctly to grow wealth. And so that is kind of where that spawned out of was the 2008 financial crisis. In 2010, I'd gone to a friend of mine that's now a business partner since 2010. And I said, hey, listen, Chris, I'm in real estate. You're in tech. I'm getting hammered right now. I don't have the money to go out and buy property. I just know we need to go buy it. You and I, we talked about owning apartments, but I don't have the money to go do it right now. I need someone with some capital and the ability to sign on our loan. And then I'll go find the deals. I'll analyze them. I'll help put the money together and structure it and do all of that. I'll, manage and close it and I'll do everything, A to Z, all the sweat equity. And then we'll split things 50-50. And that's how our company started in 2010, the Brennan Pulley Group Capital. And so we've gone from that $100,000 condo. And then in 2017, we had acquired about 4 to 5 different properties, little duplexes, fourplexes, triplexes, amounted about 20 units. About $3.5 million in assets. We thought we'd made it, right? It was great. But then we learned this thing of OPM, other people's money. And I'd gone to a syndication conference and around 2017-ish. And we're like, gosh, like we really want to scale, but we're running out of our own capital. Like, how do we do this? How do we find deals, analyze them, raise money, structure them, bring in investors too, attract money into our deals? Maybe some creative financing, seller financing, these things. And how can we grow our portfolio to where we want to go, which is ultimately 10,000 units. Like that's where we're headed. 10,000 units and $1 billion in real estate. That's where we're going. So today, as it stands right now, we go from 2017, 2021, we start scaling. Okay. And as of it stands right now today, we're at about 600 plus units and about $180 million in assets. And that's where our company's at today. Now, I'd say we would have scaled double that had 2022 and the interest rate hikes not hindered and stopped and slowed down. But we're moving now. But that's kind of where our progression is at. And that's a little bit of my story into the multifamily space. And we have apartments in about 5 different states around the country. Okay. And so we manage stuff in state, out of state, wherever we're at. And what that led to was this, is really doing community and understanding the game of money. And all of these other things. Has anybody ever explained this to you before? What money is? So if I were to ask you right now, what is money to you? Chime in the chat. What is money to you? Is it freedom? Is it choices? What is it to you? Because you're here tonight because you want to make more money. But why? Right? Because money does something for you. It gives you something. So what is it to you? It's a catalyst. Good point. Yep, I like that one. It's a tool. I like that. but chime in some more. Like, what is money to you? Because in order for you to kind of go from where you're at right now, whether you're in a 9-to-5 job, whether you're an entrepreneur and you're doing stuff on your own and growing things, like there's got to be something in your belly that like drives you. Okay. And you got to find that. And we're going to talk about that a little bit tonight, because without that, then anytime you hit any headwind, anytime things aren't going your way, anytime you feel whatever it may be, you're going to stop, because that belly is not driven by something. So freedom and options. Yeah, freedom and options. That's what money is. So this was explained to me, and I thought this was brilliant. I'm becoming ambidextrous, by the way. I'm right-handed, so bear with me. But money is a game. And once you understand how the capitalistic system in the United States of America is set up, and how the IRS, who are not our friends, by the way, but they try and be our friends, how it's all designed. Okay, you have creators, and then you have contributors. Based on all of your experiences and what you told me here tonight, most everybody in here is a contributor, right? You're a W-2 employee. You collect your paycheck, and then you go do it again, and you're working for the man. You have creators over here. These are business owners. These are investors. They are paid through 1099, right? They don't know where their next paycheck's coming from, but they have created products or services into the market, right? Creators create products or services that then come here that are consumed by contributors. The money leaves the pocketbook of the contributors and it goes over to the pocketbook of the creators. And that is literally the United States of America capitalistic system. So you have creators versus contributors, creators versus contributors. Now, how does this apply to you? I mean, think about it. You're here. You want to be here because this is where all the freedom's at, right? All the financial freedom, everything that you're talking about and you're wanting, right? It's here. But that's not that easy to do, right? That's not that easy to do, but it absolutely can be done. I've done it. I transitioned. This can be done. And if you're not here now, you can get there, right? The question is, do you do it alone? Do you do it inside a community? Do you do it being handheld? How do you do it? What's the fastest track with the least amount of headaches to get to where you want to go and get a result? That's what it really comes down to. But creators are where all the money's at. The IRS loves creators because this is why all the tax breaks go to them, because they're creating money. They're creating wealth. They're moving money. They're moving lots of money in the U.S. economy. And as a result of that, the IRS gives you the tax breaks. Okay. Perfect example. This is actually brilliant for what's going on with the elections. So I think, if I'm not mistaken, Kamala Harris's economic plan is going to give like $50,000 tax break for starting a new business, right? New business. Okay. So they're giving you the tax breaks, not because they love you, because what happens is she's going to raise the corporate tax rate, right? I think 10 points, 10 percentage points, because they're going to give you the break going in the door. They want you to grow the wealth because they're going to take more on the upside, right? They're going to get theirs down the road. That's why they get all the breaks here. So that way you can grow your wealth, get a big piece of a pie, so the IRS can get a big piece of it, right? That's how the system works. That's how it's designed. But just FYI, that is the game of money. Does this resonate with anybody? Does this make sense? Does this make you happy, sad, pissed off? What does it make you? Because this is the game of money and capitalism in the U.S. economy. This is it. And the question is, where do you want to be? If you're here, you want to get here. If you're here, this is great. You want to stay here and grow here. Dean said, problems without proper knowledge and guidance, but it will afford you freedom. There you go, baby. I like that. Your income, and I want you to, this is one of the greatest quotes I ever heard. Your income that you're making right now is equivalent to the problems that you're solving. If you want to go make $1 million, then you need to solve $1 million problems, right? I mean, this is how it works. Your income is equivalent to the problems that you solve, period. Period. Okay. Tax dodgist is key. Tax avoidance. It's all legal, by the way. Okay. Tax avoidance. Okay. Let's keep going. So I'm going to put this up, poll real quick. I want to know, what are your 7 mountains? Okay. What are your 7 mountains? So this was brought to me some time ago. The 7 mountains that move a nation and inspire people. So this gets to your belly. This is the fire in your belly. Are you inspired by sports and culture? Are you inspired by family and philanthropy? The media, like, is that like you want to get into media and be around media, right? How about government? Maybe you like politics, business, education, and religion. Which one of those, right? Take three or four. Which ones like get you going? Like if you had $1 million liquid in your bank account today, so you had some money and you didn't necessarily need money per se, what's going to get you out of bed then? If money's not the motivator anymore because you have some, what's going to be that driver? Because that's how you answer this. Because for me, for example, business is number one, right? Business is number one. And then the media is number two, because the media allows us to grow our profile to then help educate. And then from the education, it allows us then to come over here and give back, right? Not only to my personal family, but also to philanthropy, charities, causes, things we love dear. Like we're involved in Tunnels to Towers, Seal Future Foundation, and a lot of things with disadvantaged kids around the United States. Like those are near and dear to my heart. Remember this, guys, because this is how you make decisions in life. This is how you take the next step, right? You almost have to get mad. You have to get pissed off, because when they say people make decisions in life, I found this super interesting. They did a study on this, and they said, if we asked 100 people, do you make decisions based on pain or pleasure? The response is 75% will say pleasure, like they're moving towards something pleasurable. Bullshit, okay? We know statistically it's the complete opposite. People make decisions on pain. They're trying to move away from something painful or avoid a painful event or not have something happen to them, right? A fine, a fee, bankruptcy, whatever. You're trying to avoid that pain to go to something else. So that's how decisions are truly made. 75% on pain, 25% on pleasure. So what moves you? Because typically it's going to be a painful thing, right? You're trying to avoid that, and that's why you go. So remember that when you're trying to get to where you want to go in life and you're trying to do all of this, there needs to be some pain, because that's how you're truly going to move it. There has to be some fear, and there needs to be some pain. You got to get to the edge of the cliff sometimes, guys. You got to jump off and allow the how to show up. You have to allow the how to show up sometimes. You're not going to have everything figured out. Ain't going to happen. I would have never gotten to where we've gotten, being a more C-type analytical personality, if I would have gotten to the edge of the cliff every time and then ran into paralysis by analysis and walked myself back every single time. I would be sitting in a cubicle job right now, right? But I had to get to the point, I had to say, F it, screw it. I got to go. I know what I want. I want it bad enough. I have to go through the pain of getting it. And I'm so scared of that pain over here. I'm going. Like that pain is what made me go. It makes me go every day. Okay. So Multifamily School was created. And that's what's up now. That's like all of this stuff you're in here today, all the back end stuff we've created was Multifamily School. And we created a community and an education to help people learn multifamily. But more importantly, because through the community, now we can grow, right? Now we can help people get into multifamily, learn it, execute, own their own buildings, get wealthy. And then by that success, everybody's now growing, because now we can partner on deals. Because the one thing you're going to learn, if you don't know this yet, multifamily is about partnerships and collaboration. That is how you grow. That is how you use OPM, other people's money. That is how you scale. That is how you get the financing. That is how you find deals. That is how you analyze them correctly. All of that stuff that we're going to go through tonight happens through partnerships. You will not be, the idea of trying to do this alone, you'll be exactly where you're at right now. I had to learn this sometimes the hard way, but collaborations, community, and partnerships, and having that around the country is why we created Multifamily School. That's why you're here tonight. That's how we're going to get to 10,000 units on our portfolio. That's how you're going to get to your first 10 to 30 unit building, and then maybe a 50, and then maybe 100. It's going to be through partnerships and collaboration. Okay. So Multifamily School, and just have people learning, doing this stuff around the country. These are some of the people that are in the community now that are finding their first deals, second deals, third deals, and so forth, right? I love it, because this goes to the education side, right? Remember I talked about the 7 mountains? The education side. We can give back, help others. The law of reciprocity kicks back in. They have success. Now we can see deals we may not otherwise see. Now we can grow our portfolio through partnering with people in the programs and other things we do. That's where it's at. That's where the growth happens. So that's why Multifamily School was created. And that was a couple of years ago. So how to buy apartments. Who here would like to go through a couple case studies on exactly how to buy an apartment in the next 90 days? Thumbs up. Give me a thumbs up in the chat. Would love to know. To get anywhere in multifamily, you must get a team. You are correct in that. So you are correct in that, Daniel. However, you don't need a huge team in the beginning. If you do want to grow and scale, yes, you do. In the beginning, you can actually run pretty lean and mean. Because the first deals you're going to do is going to be somewhere in that 10 to 30 unit space. That's what we teach. That's what we coach. That's where we mentor and the community and everybody that's doing deals in the community. They're all starting in that pocket, 10 to 30 units. And there's reasons for that. We're going to get into it. So how do you buy a multifamily building? You got to know how to find them. You got to know how to analyze them quickly. Is it a good deal or not? How do you finance and structure them? Raise the capital, structure the deal, attract investors, make creative financing opportunities. How do you do all this stuff? How do you close the escrow on this thing so you don't get into a money pit? How do you do due diligence, inspections, all these other things, all the legal mumbo jumbo that goes on? How do you do all of that? Then lastly, now you own this beautiful asset. How do you manage it? If you're going to hire a third-party property manager, how do you do that? What questions do you ask? How do you interview? How do you hire the right ones so you don't like find out your property burns down next week? How you can have it, especially if you're managing out of state. How do you do that? These are the 5 elements. And then the other thing is, how do you make money in multifamily? Has anybody ever wondered how you make money in multifamily? Chime in, thumbs up. Right? How do you make money in multifamily? People always ask that question. I hear that a lot. Hey man, seems great. I love it. How do you make money? I totally get it. How do you make money? There are, remember I said there's 5 to 8 different ways. Remember I said that? There's 5 to 8 different ways you make money throughout the life cycle of ownership of a multifamily apartment building. Here they are. Acquisition fees. Very standard. You're doing a deal, you're putting it together, you're syndicating it, call it, for you and other people. You get an acquisition fee, typically 2 to 3% of the purchase price, the one-time fee paid literally when you close escrow on it, right at the beginning. Okay? Asset management. This is a monthly fee paid to you as you're asset managing the deal. This is above the property management fee. This is a 1 to 2% fee on the revenue for you to manage it for the investors, for your group, for everybody. Okay. Then you're going to get typically about 30 to 40% of the cash flow monthly. You're going to get 30 to 40% of the profits. And that happens a couple times throughout the life cycle of the building. You're going to get 30 to 40% of the tax write-offs, the benefits of the tax write-offs, which are how, I haven't paid taxes in 7 years, guys. Not because I don't make money. It's because you use accelerated depreciation, legal tax loopholes. Remember, the IRS loves creators. Why? Because we're moving a lot of money. And if you move a lot of money, they're going to give you a lot of benefits so you can continue to grow because they want a piece of a bigger pie down the road. Okay? So 30, 40% of the tax write-offs. Construction management. Let's say you were doing some renovations on the building. You're renovating a 20-unit apartment complex. There is built into that, you build in a construction management fee of 5 to 8% of the cost of the construction management, or the hard cost of the deal. Okay. And then when down the road, let's say you sell this property 5, 6, 7 years from now, there's what's called a disposition fee, disposition fee. One-time fee, no different than the acquisition fee, usually ranges from a 0.5 point to 2 points, 2% on the sales price. Another way, if you're really good at finding deals, literally, if you did nothing else and you came in here and you're like, man, this is really cool. I can find some good deals for Justin. Brilliant. Find some good deals. If that's all you want to do is find good deals for us, you get paid 1%, typically 1% of the purchase price. Plus, maybe you get brought into the general partnership side of the deal in small piece of ownership too. That's another way you get paid. So there's different ways you get paid. Pretty cool. So let me give you kind of a timeline of that, okay? On how like this stuff would break up and how you'd get paid throughout the life cycle of it and et cetera, right? So remember I said the purchase, you get 2 things there. You get an acquisition fee and maybe a finder's fee for finding the deal. That happens day 1. then all the months go by, you're getting the cash flow and all the stuff that's happening from the property. Okay. Year 1 goes by, you're getting cash flow and all that stuff. Year 2 and 3, you may do a refinance event. So you talked about doing value add. Maybe you're doing some renovations, you improve the value, you do a cash out refinance, you pull capital out. That's going to happen sometime between years 2 and 3, typically. And then you're getting more cash flow, more cash flow, more cash flow monthly. And then you get a big pop when you sell the property years down the road. All that's happening, including the tax benefits, right? 5 to 8 times throughout the life cycle of the property. And that's how it goes down. So it's almost the same every single time. I know exactly where this is going and it makes sense. Most people struggle with finding good deals. It starts there. Got to find a good deal. And how does that happen? Okay, you found it, great. You analyze it, awesome. Well, now I have something real. Like, how do I put it together? How do I structure it? How do I do the financials? How do I get a loan? How do I raise capital? Like, how do I do all that stuff? Awesome. Well, let's start with finding deals. So there's only 2 ways to find deals. So direct to brokers or direct to seller. So for the sake of time, both of these work, by the way. Direct to brokers, direct to sellers to find deals. However, if you're, like everybody said, you're kind of a 9-to-5er, you're working in a job, you have limited time, like you need to be very effective with your time because you may be finding deals at night after kids go to bed and you've had a long day of work and you come home and you're kind of double hustling. Side hustle number 2 over here, I'm going to make things happen, okay? Limited time. So for that to be effective, direct to broker is going to be the best way. And the reason for that is this. Direct to broker, you're going to utilize going to many of the online portal websites. This is how it starts, literally. And I'm going to share the screen here in just a minute, okay? You're going to go to the LoopNet, the Crexy.com, the CoStar.com. These are all free marketplaces. You can look at commercial property, including multifamily. And on these websites, you'll see properties. You can look for them, search for them, and you'll see the brokers who are representing these listings. Just know that they're all the websites collectively, total, only about 40%, okay? They only make up about 40% of the actual available deals for sale in the United States of America. A whopping 60+%, I would say, and even probably more than that, quite honest with you. It's what's called pre-market deals. These are represented by brokers still, but the brokers haven't put them on the websites yet. And the reason why is because they've got the packages together, and then before it goes to the website, they send it out to their little investor database like me and other people, and we get a first look, a pre-look at it. And if we like it, we'll write offers and we'll put them into escrow before it ever sees the light of the day of the website. And you're like, yes, Justin, we know this. Captain Obvious. I know that. Now the question becomes, how do you execute? And how do you find these? And how do you get access to these? Because we know these are there. How do you get access to these? This is how you do it. You're going to leverage the brokers on-market deals to get access to their off-market deals. Okay, perfect example. Let me share my screen real quick. And we're going to go, I'm going to literally show you a case study tonight. So let's take this property. I just pulled this one up in Tennessee. 23-unit deal. Represented down there, you can see in the bottom left there, Mr. Austin and Mr. Sam Jackson. And they are with Pro Commercial Services. Okay. Little 23-unit in Tennessee, Memphis, Tennessee. So this is how, if I liked the Memphis market or Tennessee in general, right? And I was going to go into that market and start looking for deals. This is how I would start. I'd go on to Crexy.com. This is Crexy.com. I'd look for deals in Tennessee. And then I would start taking, okay, this little 10-unit deal, 20-unit deal, awesome. This guy Austin, this guy Sam look like they're representing this one. Perfect. Let's find 2 others as well. Let's total of 3. And I'm going to call each of these brokers and I'm going to go ahead and set up property tours so I can tour these properties, learn a little bit more about them, but I can tour the properties. And the conversation is going to go a little bit like this. Hey, Austin, how are you? This is Justin Brennan with the Brennan Poley Group. Hey, I'm looking at this deal in Melrose Court you have. It's 23-unit. Awesome. You guys just put that on the market about 30 days ago. Any interest on that so far? Okay. Yes, you had one offer. It didn't go anywhere. Any active offers currently? No? Okay. All Perfect. Hey, so I'm planning a trip out there. I'm going to be out there in about 2 weeks. I'd love to take a tour of that property if it's still available and meet you and take a look at the market and learn a bit more about it, because we're coming into the Memphis market. We're going to be buying there. But I came across this property. It's very, very interesting. Going to take a tour of it and we can talk more about it when I'm there. Great. Okay. So that's kind of obviously more nuanced to that, right? There's a lot of things I have to learn how to say some things, but that's how the initial process will go. They'll probably ask you a few preliminary questions back. But at the end of the day, the whole point is you're going to set up 3 tours, 3 different brokers on 3 different properties in the market you're interested in. The whole point is not about the deals. It's about getting access and building rapport with those brokers, because I guarantee you none of these deals are going to make sense. There's a 95% chance they're all overpriced. That's the point. But you're going to leverage the on to get to the off, because it's the off market, pre-market stuff that you want to get access to, but you'll never get there, especially newer, if you don't build rapport. And you can build rapport on these smaller deals, right? This is why we always educate and mentor and teach on the 10 to 30 unit, under 50 unit space, because you're going to deal with more mom and pop brokers, mom and pop sellers, mom and pop people, mom and pop everything. So they'll deal with newbies, right? More than anything. But if you're trying to go after a 50+ unit deal and you're a newbie, you don't have a chance. I mean, you might as well try and go break into the White House tonight than trying to go after one of those deals. So under 50 units, 10 to 30 is ideal. And this is how you're going to do it. You're going to leverage that. So what makes up a good deal? What makes up a good deal financially? There's obviously, we have deal analyzers you get and so forth, right? But what makes up a good deal? You want something that's returning an annual return on your money and your investors' money of at least 14 to 20% a year. You want cash on cash returns of 6 to 10% a year or more. You want equity multiples. This is kind of like, hey, I put $100,000 in, I get what out? So 1.8 would mean I put 100,000 in, I get 180 out of the deal. That's a 1.8 equity multiple. Okay. You want that or more. That's a good deal. Okay. The deal analyzers, when you plug and play in the models, they'll pop stuff out like that. It'll just tell you. Ours do it. There's probably other free ones out there and stuff that you can look at. But we can, I think most of you who signed up, you get access to one of those. I'll send you a link here. Even Kevin and Shai, do you have the link to the Multifamily Toolkit that we can put up in the chat for everybody, and they can just get access to a free Multifamily Toolkit for coming on tonight? That'd be great. That way everybody gets access to some good freebie stuff. It's awesome. So if you can put that up in there, it'd be great. Love it. Analyzing a deal. So that's, remember, step 2. Step 1, we found it. Now we need to analyze the deal. Step 1, we found it. Step 2, we're going to analyze it. So from a high level, you're always focused on net operating income, NOI, net operating income, okay? And the power of NOI. For every $1,000 a month, I can boost the net operating income. It adds over $220,000 in value. It's wild. And I'm going to show you that. And the reason why is because of the formula, okay? You can see that on your screen. We'll walk through this. Okay, great. So whether it's a 2-unit property or 100+ unit property is irrelevant. It all follows the same pattern. Obviously, there's a lot of line items built into these, but from a high level, this is what it looks like. You take the gross rents, gross income from the property. You're going to take out what's called economic loss. This includes physical vacancy, loss to lease. That's the difference between market rent and what you're getting. Bad debt, people not paying rent. Concessions, you're having to give away free month's rent for people to come in, stuff like that, right? That's going to total about 12 to 18% in most of the markets in the United States. Coastal markets are different. They're less, but anywhere outside that, 12 to 18%. Then you're going to add in other income. This could be pet rent, could be parking income, could be cable income, trash income, admin fees, all late fee income, all kinds of other income. That gets added in. And then you get to this number called EGI, effective gross income. Effective gross income. You keep going. You're going to effective gross income. You're going to take out your expenses. So this could be property taxes, insurance, repairs and maintenance, property management fees, all these expenses that get taken out, the line items of expenses. Okay. That comes out, and then you get to this beautiful number, net operating income. And if you want to determine the value of any commercial building, See, because unlike residential real estate that's valued based on comparables, meaning my property and comparable to others, that's how I establish my value. With commercial, it's simply a mathematical financial gain. So the higher I can get this number, my value goes up because the value equals the net operating income over a cap rate in the market. That's determined by sales and brokers and other things, okay? So the higher I can get the net operating income, the value of the building goes up. Simple math. Then you take out your mortgage payment, you get this beautiful thing called free cash flow. And that is how, from a high level, how you evaluate a deal. And there's metrics and things you need to look for. So raising the money. Does everybody want to know how to raise money? That's usually where people get stumped, right? Because we can teach people how to find deals well, analyze deals, but then they always get stumped at the capital side. What's funny is what we ended up doing too recently is inside the community is we brought in lenders. And that way, when people have deals, they find them, they analyze them. It's a good deal now. Now they can actually do the capital inside the back end of the system. So from getting the lenders to help look and underwrite and raise the capital, as well as the financing for the loan, all done in the back end now. To kind of alleviate the bottlenecks that people were having, finding their own lenders and getting out there and figuring it out. We brought everything in the back end, so it just makes it much more fluid and alleviating bottlenecks. People, once they find them, they analyze them, here we go. Now you actually have a deal you can lock and load on and actually execute. So in order to raise money, you need really three things. You need a deal that makes financial sense. You need a pitch deck that's well put together. And you need a process that helps people do it, right? Brings them in a process that'll raise the money, okay? So a deal that makes financial sense is one of these. Remember, we went over it. The returns. You need a pitch deck. You need a pitch deck. There's the link to the toolkit that was just put in there for you. There is a pitch deck, pretty good one, inside that free toolkit for you. You'll get a pitch deck, deal analyzer, checklist, due diligence things, some other basic multifamily toolkit stuff, all for you just for coming on tonight. So thank you, okay? But all for you to kind of like, some resources for you. Pitch deck and then a process. If you have those three things, you'll raise money. I mean, think about it for a minute. If I came to everybody on this webinar tonight and I said, hey, everybody, here's a 23-unit deal in Memphis, Tennessee. Projected returns are about 18% a year on your money. Minimum investment's about $25,000. It's about a 3 to 5 year hold on your money, and you're going to be getting the returns paid out quarterly on your money. Do you know anybody that may have some interest? Right? 18% projected returns per year on your money for $25,000 minimum investment. Who do you know that may have some interest? And then you're going to be like, well, yeah, 23-unit deal. I'm going to be an owner in it. I can get 18% a year on my money. It's $25,000 minimum. It's like not a huge amount. And sure, I'd be interested. Like, can you send me more information? Sure, I can. Send you a great pitch deck. That pitch deck's going to break the deal down for you, show you everything, right? How much money we're raising, what we're doing, projected returns, your projected returns, how it's all going to shape up and structure. Everything's in there in a nice little pitch deck. And that helps answer 95% of the questions for any investor or anybody interested in investing, okay? And then a process for it to flow through. So that's exactly how it would happen here for everybody on here. Does that make sense? Beautiful. What's the lockup period for the lenders? Lockup period for the lenders. What do you mean by that, Johan? When you say lockup period, you mean time, the loan terms? Typically 3, 5, 7, and 10-year loans. But right now in today's market, 7 to 10. 7 to 10-year loans right now. How long is their money out for the lenders? Yes. So typical commercial loans are 3, 5, 7, 10 years. But right now, most people are taking 7 and 10-year money. Got it. Good question. Good question. Okay, let's take a case study. This is this is the exact deal there in Memphis. Okay, I pulled it up. We're going to walk through it financially, show you what the financials would look like, break it down and structure it for you right here live. So they're asking $1.4 million for the deal. Let's say we get it for $1.3 million. Okay, we're going to put in $10,000 a unit to renovate it, so $250,000. We have about $100,000 in closing costs. That's title, escrow. That's your acquisition fee as well, built into that. Remember that acquisition fee built into that number, and any other title and closing costs that are in there. So you're all in at $1.65 million. $1.65 million all in cost, right? Tracking? Here we go. Now the question is, great, that's awesome, Justin, but how do we break that down? How does that work? Well, you're going to go and get $1.2 million loan. You could get it from some of the partners inside our community. Because you'd send them these financials on this deal. They'd say, yeah, that looks good. It meets all the parameters. Here's your money. 70% loan to cost. 70%. So you're not over leveraged. You're keeping your leverage good. 70% loan to cost, $1.2 million loan. This loan would be easier to get than a $300,000 house loan in the Midwest. Remember why? They're looking at the property's financials. They're not looking at you anymore. You're secondary in the process. You don't need to have amazing credit. 600 credit or better, you're cool. And if you're not a fraud, you're cool. 600 credit or more, you're all right. You're not a fraud. Then you're good to go. Okay, if you're not a felon, anything like that. Then you can get this loan, right? Now the delta, $1.65 million, $1.2 million loan. The difference is $450,000. So then how does that come in? You're like, great, Justin. Yeah, I can get the loan. It's $1.2 million. But now I got to bring in $450,000. How the hell am I going to do that? Here's how you're going to do it. 10% comes from you as the general partner in the deal. Remember I say in the headline of this thing, how can you buy a 30-unit multifamily for $18,000 out of pocket or $30,000 out of pocket? Here's how you do it. The 45 is going to come from you. That's 10%. But remember, you get an acquisition fee literally at the close of escrow, like Peter to pay Paul. $26,000 based on 2% of the purchase price. It's $1.3 million purchase, 2% of that, $26,000. So you're actually out of pocket $19,000, physical out of pocket, but you invested 45. Okay, so 45 went in, 26 came out. So your actual net is 19. Okay, 400,000 is going to come from OPM, other people's money. Now, other people's money is made up of a lot of different things. Could be seller financing, could be private lender person, could be friends and family, people you know, maybe people you don't know. My first deal was a 27-unit in Kansas City, Missouri. $2.2 million deal. I think we were all in at like 2.25, whatever it is, and change. Maybe like 2.3 and some change. Excuse me. $1.6 million loan. Rest was in equity. Raised about $890,000. We brought in 75,000 of our own. The rest was raised. So I raised over $800,000 on my first deal. And how did that happen? I didn't really have a network at that time. But what I did have is I had a deal that made financial sense. I had a pitch deck that explained the deal to anybody who had interest. And then I had a process for them to invest with me. And we raised the money with like 5 people. You'd be shocked. You'd be shocked. Go find a good deal. The money will find it. Always has, always will. Okay. So don't let that be a block for you. Everybody gets stopped by it. And I would have done the same thing. And if I would have let it stop me, I'd never be where I'm at. Okay. Don't let it stop you. OPM, seller financing, private money. That's how it's going to be raised. So the 400 grand comes in with your 45, you're done. The loan's in place. And now you are the general partner on a 23-unit deal in Memphis, Tennessee. Memphis, Tennessee. So now how would this deal structure legally? How would it structure? Well, the property is going to be owned inside a single asset entity. You're going to have you as the general partner over here, limited partners as your investors over here. You're bringing in 10% of the money, remember. They're bringing in 90% of the money. For that, for bringing in 10% of the money, you get 30% of the deal. Cash flows, profits, everything, right? Coming out of the deal. For bringing in 90% of the money, they're going to get 70% of the cash flows plus a preferred return. Plus a preferred return. Now, here's the cool thing. And most people don't even teach you this. As a general partner in the deal, you putting it together, you get to what's called double dip. Your money, your 45,000 that came into the deal, actually invests right alongside your investors. Right? Here's all your investors. 1, 2, 3, 4, 5, 6, 7. You are right here, literally investor number 7 in your own deal. So you get your percentage of this over here, plus you get that on top. Your returns are stupid. Like they're off the chart stupid. Because think about it. If you're only 19,000 out of pocket and you're getting all of these benefits, right? You're getting the acquisition fee. You're getting an asset management fee. You're getting 30% of the cash flow, 30% of the profits, an 8% preferred return on your money in it. Your money and your percentage of this 70% as well Okay. And this all happens over this timeline, right, that we discussed. Some in the beginning, then every month, right? Then you do a refi, few years, you keep going, you keep owning, cash flow, cash flow, cash flow, tax benefits, all these other things happening while you're owning the building. And that's how it goes down. Any questions on this? Because this is usually where a lot of questions come up. Any questions on this before I move on? So Daniel, DSCR, that's what this is. It's a debt coverage ratio loan. That's how it's easier to get the financing versus a residential property. It's a debt coverage ratio or debt service coverage ratio, SCR or DCR. Same thing. Yes, Evan, you are dead on with that. If you can refinance out your investors on your refinance, then you now own 100% of the deal. So let's walk through that real quick. Evan, is this not your first rodeo? Because that's pretty sharp. That's what you should be doing right there. That's what we did on our second deal. We did that. Let me walk through this one. Okay. So let's talk about the money again real quick. To answer on Connie's question. Can you please explain the $45,000 that comes out for you first? It's not 45, by the way. You're putting in 45. Then you're getting an acquisition fee, which is built into the closing cost of $26,000. Very standard. So it nets you out. You're really only out of pocket 19 grand. And that happens at the close of escrow. So your 45 goes into the deal along with your other investors. You close the escrow, you get paid the $26,000. It's all built into the total cost of the deal. Okay. That way you're netting at the 19,000. Okay. Netting at the 19,000. What Evan was talking about is this. You purchase the property here. Maybe you're doing some renovations and stuff, right? You're getting cash flows, all this stuff. It's all cute, very cute. And then right here, around year 2 or 3, you can do a refinance because now you've renovated the property, you've increased the rents, the value of the building is higher now. So now you go back to the lender and you say, hey, lender, take a look at my deal now. I bought it at $1.3 million. It's now worth $2 million. Right. And we have right. Think about this. We bought it for $1.3 million. It's now worth $2 million. We have $1.2 million loan on it. But based on $2 million, now I can go get a 70 to 75% loan on that. So that's now $1.5 million, call it. Okay. $1.5 million on 7, it's called 75% or 70% of 2 million is $1.4 million. 75 is called $1.5 million for simple math. So that pays off the existing mortgage, plus you have $300,000 left over. Well, that $300,000 goes and it pays off about 80% of your investors on the first refinance. So now they are not in the deal as much anymore. And now you control more of the deal now. That's the beauty. And then eventually maybe you refinance again down the road, take them out altogether. So now you have 100% control and 100% of the cash flow and 100% of the profits and 100% of everything of a 23 unit. So you can do that. Definitely a method. Definitely a method. Let me show you, this is a case study. This is another deal we did, but this is like a perfect case study of how $18,000 of my own money I was out of pocket on this deal. Okay. But how did this break out for me? So 31 unit deal. We bought it for $1,525,000. We put in about $400,000 in renovation. Closing costs of about $225,000. We were all in at $2.15 million. We structured this deal as a 60-40 split. So 40% went to us, 60% to our investors. We went out and got a loan for $1.5 million. That was about 70%. Super easy to get. That left over about $645,000, $650,000 in the equity we needed to bring in. We brought in about 10%. I brought in about 10% into that deal. 90% was brought in from friends and family and OPM, other people's money. We did that with about 7 people on this deal. We raised that between $25,000 checks, $100,000 check, a $50,000 check, one $75,000 check, right? We raised the $581 pretty easily. Now remember, $64,000 went in. I got an acquisition fee of $45,000 coming out. I was then technically out of pocket $18,000. Out of pocket 18 grand. Now look what I got. So on that 31 unit, we took the value. Evan, this is perfect for you and anybody else that does the cash out refis. And you're looking about value add stuff and all that. Beautiful. Took it from $1.5 million. We increased the rents by renovation. The building now is worth $3.6 million. Within 24 months, we did a 100% cash out, plus more money on top of that. I was getting an asset management fee of 1% paid monthly, 40% of the profits in the cash flow. So about $2 grand a month for 5 years is 120 grand. That's what I was getting. Net profits when we sold it about 470. I made $590,000 on my $18,000 out of pocket. My returns are like stupid. 18 grand, 590 on 18 grand. Now, that increase in value is not necessarily normal per se. I'd say 1.5 to maybe 2.5 would be very normal. We got lucky. We bought the heck out of this deal and got lucky. So they're not always that sexy, but this is a good example. Okay, good example. That's what I made. Okay. So mentorship community. If for all the people that want to do this, are there people that feel, do you believe you can do it alone? I mean, some people do, some people can't. Totally up to you. Do you believe you could do it alone, or would a community make more sense for you? I'm just curious. Everybody here tonight, is community sound more fun and more appealing to be able to collaborate, work together, learn, grow, do deals, raise capital inside, get financing inside, help with any bottlenecks? Like, is a community worthwhile? Yeah. Great, Thomas. Yeah. I mean, everybody had thought too. It just depends. Everybody's different, right? Everybody's different. So, and listen, it's not for everybody. You know, we have a mentorship community that people can come into and learn and collaborate and partner on. But it's not for everybody because, yeah, it is, I guess it is expensive, but it's not expensive when you think it's the result. Because you can go do it alone. You can spend time in thousands and time, just you can lose a lot of money, but then never get anywhere, right? Or you can basically try and do it on your own, which is fine. I've had people do that. Some people are successful with it, some are not. Really depends on you. Or you can fast track it, avoid mistakes, save time and effort and money, get the result, right? The key for most people is they want to feel like, how can I guarantee my result? And how can I make this happen if I'm going to invest into something like that, right? So it's not for everybody. If you're interested in doing this, right, and you want more community, okay, we have something for you. Okay, so we put this together. This is what we're doing, and you can come inside it if you want. What do you get inside, right? First of all, we have a 90-day guarantee on it that if we can't help you locate a deal that makes financial sense for you in 90 days, you can request a refund. Straightforward, okay? We're going to put our money where our mouth is on it. Okay, obviously everybody needs to do their part, right? We'll do our part. Everybody needs to do their part. I can't force people to get out of bed every day, but if you're in it and you're engaged, we'll make it happen. Weekly coaching sessions with me and the team. We're going to handhold you every single step of the way. You're going to get me, not hired coaches, not random people, me. Very big difference, okay? Personal success coach assigned to you as well. It's going to help hold your hand, accountability, guiding you through the program, all the community stuff that goes on, lifetime access to all the tools, the systems, the community, the resources. As I said, 90-day guide and action plan that's going to go step by step, week by week of everything we've gone through to the 10th degree, okay, and more so. The key is the community and the collaboration, everybody you're going to be partnering with, and all the people and the students and everybody in the community inside. That's the key, okay? You get the programs inside, you get the document library, all the opportunities to partner on deals, financing, all that stuff, and all the tools we have in the back end. We're going to assist you in finding deals. We're going to assist you in analyzing those deals. You can submit your deals. We help you literally review them alongside you in the back end, okay? Financing. We have all the financing partners in the back end where you can actually submit the deals. They can review them and help provide the financing and the loans and the capital, all inside the back end. Our team assists you in the closing. Our team assists you in setting and managing. It's not 68 grand. Don't worry. You get access to all of our systems, our vendors, everything, the tax hacks, real estate tax hacks, the whole 9 yards. Is this something that would be of interest to anybody here tonight? And I'm not trying to sell anybody anything, but if you're interested in taking your next steps and you think the community and you think handholding and mentorship can help guide you there, then we should have an informational phone call. See if it makes sense for you. Maybe it does, maybe it doesn't. Okay. Maybe it does, maybe it doesn't. But if you do, if you have interest, I want you to put your name, email, and phone number privately, not to everybody, into the host and panelists inside. And you can do that now. And then we can set a reach out to you. You can also, let me put this in there. You can go ahead and book an informational phone call right here. I'm setting the link in there right now. You can set up an informational phone call to go through this, to find out more information, see if it's a good fit for you. And just FYI, so we're straight up about it, okay? So normally whoa, that's big writing. Normally the program is $8,800 to get into the community and to have everything. What we do for people that come on to the webinars is we'll take $1,000 off this thing for people that are on here tonight. That's why putting your name and email and phone number in the system so we can track it, we'll give you the discount. Therefore, it's only $7,800 for you. Okay? Just FYI. I like to be very straight up about it. There is an investment to it. The key is the 90-day guarantee. We're going to help you get a result. We're going to help you believe that. Let's get on an informational phone call. If you truly want to make this next step and you think it's the right message for you and you want to do it not alone, we can help. Okay? We can help you do that. But that's the key to it all. Minimum credit score. Anthony, minimum credit score. If you don't have it right now, don't worry about it. But ideally, you want to have a 600 credit score or above to be able to get financing. Yeah, and as long as you're not like a felon or a fraud, you're fine. But yeah, 600 and above. If you're close to that or right around it, you can build that up pretty quickly. Just depends. But 600 and above, you can get financing. Great question. The key is access to other people doing deals, partnerships and collaboration, learning from others, access to resources and tools and everything. Like you don't need to go out and do anything. Like we put literally deal analyzers, pitch deck, due diligence checklists, legal documents. I mean, every single thing that you're ever going to need to go buy an apartment complex, we give you the resources and tools, and you have it for lifetime. You have lifetime access to the community, the collaboration, the lenders, the people, I mean, we're going to do meetups. We have pop-ups that are popping up around the country, which we love doing. People can start meeting each other live, not just virtually. That's key as well, because when you're part of a community that's actually doing things, that's where you're going to like drive, right? We don't want you feeling isolated and alone and not being handheld. We really want you feeling supported. That's a key component to it. So asset-based loan. Let's see. Let's go over some of the questions. It's asset-based loan. Deal is right. Finders will jump. Yes. Need DP to work with. Hard money, private. What did you mean by DP? And that was from Evan. Down payment. Yes. Yeah. You gotta have some cash in the game, guys. So that's why we say, I mean, if you're putting in 30,000, 40,000, 50,000, right? I mean, my first deal, we had 65 in, right? I got 45 out. I mean, and then we did the deal. And then I had control of a 31-unit apartment building in Kansas City, Missouri for $18,000 out of pocket. So I'm telling you exactly what I've done. It's not, and we're doing it over and over and over again. Now we're just doing bigger numbers because we're doing 100+ unit deals now. So we're going big style. So our deal size now is between, depending on where it's located at, between 80 to 220 units on average is the size deals we're doing now. So can I use a HELOC in addition to the acquisition fees to cover the down payment for a good deal? Absolutely, you can. Yeah, I mean, if you're going to take money out of, say, another real estate asset, invested into another real estate asset, that's called good debt, by the way. I mean, this whole Dave, I love this Dave Ramsey guy. Guy cracks me up. Listen, he's done very well for himself, but he doesn't understand the game of money I just presented to you. because the game of money, debt is good if it's good debt. Bad debt is consumer credit card debt. That's bad debt. When you're taking debt on credit cards to go buy stupid shit, that's bad debt. Good debt is when you're taking debt to go buy appreciating assets that are appreciating at typically at least 2 to 3 to double the rate of your interest loan, right? So if you have a 5% interest rate, but the property and everything's appreciating at 10+% a year with everything involved, you're winning. That's good debt, okay? So absolutely. Anybody can find 18 to 50,000 if they have a minimum. Yeah. Daniel, great point. Anybody can find 18 to 50,000 if they have a minimum 600 credit score. I would agree with you on that. Yes, 100%. Being led by someone actually out there doing is priceless. It's not just an education that I'm buying. Love it, Daniel. Yeah, you're dead on. You hear it all the time, and people that come into the community, maybe they were in other ones or whatever, they were taught by, like, they got in, they paid money, they did all this stuff, but then they were taught by a coach who wasn't even doing anything or hadn't done deals, or maybe they'd done one deal and they're not active in the market. They're not really doing it. They don't know how to really talk nuance, because the key is the nuance, right? I mean, there's a lot of like book stuff in here, which is cute, but when you get into the real nitty gritty and deals are really happening, and there's a lot of things happening going on, you need access to the actual mentor, which is why when people come into the community, they literally get my physical email and my personal cell phone number. So, I mean, not only do you have your success coach inside, right, but you have me, and you literally get direct access. And we're chiming in the chat and the community and all that stuff all the time, showing off market deals all the time, collaborating with people all the time, answering questions all the time when we're in there, and trying to grow that thing, because partnerships are where it's at. I mean, we're starting to have, what I love is people inside the community investing in other people's deals. Like, that's like what we love seeing now, because you'll see, like, there's this guy, Steve Parker, is doing some deals in Cleveland, Ohio, right? And they're pretty good deals. And he's bringing those deals up on screen in our little kind of coaching sessions once a week. And the other students in the cohort, like 3 to 5, are like, oh crap, like, I like that deal. So they're reaching out saying, hey, maybe we can invest in that deal alongside you. Yeah, that's what that's what it's all about, is sharing deals, doing deals, collaborating, partnering, helping each other out, guiding each other. That's a true community. Okay. All the millionaires and billionaires say debt is how they keep paying from paying taxes. Yeah, because debt's tax-free. Remember, when you do a cash out refinance, when I pull cash out of a real estate asset, because of the IRS and the way they classify that, remember, I'm a creator. They're going to give me the tax benefits so I can grow wealth. They want me to move as much money as I can. So if I can pull money out of a real estate asset, they classify it as tax-free money. I can now take that money and move it, go buy more stuff, gain more wealth. Why does the IRS love that? Because down the road, the IRS is going to get a piece of a bigger pie. They're not dumb. They're not doing it out of their good heart. They just love creators more, because creators create more money and wealth and opportunity. And with that, they gain more wealth and they can take more money down the road. Now, there's tax loopholes, there's tax this, there's tax that, yes. But effectively, at the end of the day, the IRS is going to get a piece of a bigger pie. That's just how it goes. What is the difference? So Thomas asked this question. What is the difference between using your own money versus raising funds to close a deal? If you use your own money, you keep more profit. I've saved $150K. What can I do with it in buying a small apartment deal? Great question, Thomas. So yes, can you go put in all the money? We did that. That's how we got to 20 units, doing little duplexes and triplexes and fourplexes. And it was great. We had about $3.5 million in assets. The question is, where do you want to go? Because the smart play, okay, the non-sophisticated investor newbie would use all of their own money to go buy real estate. The smart, sophisticated investor would use some of their money, which we do, in conjunction with OPM, because I want you to put this in perspective. We had $3.5 million in assets and owned 20 units, and we had 100% of that. That's where we were at. Now, by taking some of that, going over here, we're able to scale our portfolio and go from 20 units to now 600 plus units and $180 million in assets. And now we own about 35% of 180 million, or 100% of 3.5. Does that sound like a good transition of money? That's why you use OPM. Okay, that's why you use OPM. Lenders love to lend. Yes, they do. If the deal makes financial sense, they will throw the money out the front window of their bank. Literally. Because it makes financial sense. They need to, you understand, lenders need to lend. If they don't work off deposits. I mean, you understand how the whole game works, right? They take our deposits, they put it into their bank account. They can 10x that money, put it into investments, right? Other types of lending in different asset classes. And that's how they make their money. That's how banks make money, right? They're leveraging your money, right? OPM. That's literally what a bank is doing. They're taking some of their money, all of the depositors, meaning us, you, me, everybody together, OPM, and they're going and they're putting it out into the marketplace. OPM. That is what a bank is. It is a big ass OPM. So a HELOC, credit score 750, 10K in cash, and potential acquisition fee gives me all I need to start. Am I correct? No. So Connie, you probably need a little bit more cash. Your credit's great. Everything else is great. Probably need, but don't let that stop you right now. But if you have somewhere around 30,000 liquid, then you can invest into a deal. Yes, you're going to get an acquisition fee back. Okay, it's Peter to pay Paul. But let's get it on information call. Let's chat some more. Okay, but you're right there. I mean, you're absolutely in a great position to execute. Okay. Yes, you certainly want to vet investors and people to come into your deals. Yeah, you don't want to invest just with anybody. But you keep in mind, you're controlling it. You're the general partner controlling the deal. You have voting rights. So when you do all this stuff, right, when this whole structure deal, this game of structure, this one right here, okay, this structure right here, you're controlling that. You're the general partner. You have the voting rights. They're passive investors. They've invested passively. All they want is a paycheck. You get to run the deal. And so for running the deal, you get paid handsomely. That's how it works. If you work your ass off and you do a great job for you and your investors, you get paid handsomely. That's why it works. Do you guys support with the tax aspect after the deal is completed, like referrals to good accountants? Beautiful, Connie. Great question. So we give you access to all of our vendors and systems in the back end of the community. So all of our accountants, our bookkeepers, we teach you the tax hacks 101 when you come in. This is all about cost segregation, accelerated depreciation through bonus depreciation, all that stuff so that you can actually never pay taxes again for the rest of your human existence. We can show you how to do that. Absolutely. This is why I have not paid taxes in 7 years. Okay, you leverage good tax avoidance strategies through real estate, and that's how you gain true wealth, right? It's not about what you make. It's about what you keep. I know you've heard that a million times, hopefully. It's not what you make, it's what you keep. Daniel said, use OPM so you can deploy more of your own good deals. Yep, we'll run out down. Yep, that's right. Evan had mentioned gap funder can take place open funding. Yes, they can. Yeah, and that could be the private lender, any kind of private money. It could be seller financing. There's different ways to come up with the gap money. So great point, Evan. Which states are we currently working in, Daniel had asked. So we still have some stuff in California, believe it or not. Nevada, Texas, Oklahoma, Missouri is where we're currently at. And we're going into Tennessee. We like the Southeast. We're just not there yet. Anywhere in the Georgia and the Carolinas and Florida, mind some hurricanes. We like anywhere in the middle part of the country, guys, is great. Anywhere in the upper Midwest, Ohio, Indiana, Tennessee, even into areas of Wisconsin and Michigan are pretty good. Pennsylvania, if you're on the East Coast. If you're in New York, no, ain't gonna happen. We're not letting you invest there. Sorry. We'll get you out of there. All of our mentees in the community that are in New York or New Jersey, they're in Pennsylvania or Ohio, or just east of that, Kentucky, some other places, just west of that. Sorry, just west of that. Okay. Some people got to go. I want to be respectful of people's time. We're at 7:20 my time, 10:20 East Coast time. So I want to be respectful. Thank you for everybody that kind of booked an informational call. If you've not done that yet, you should. And, set up that time if you want to chat some more about it. I'll put this up one more time. Don't listen. What's more expensive? Going it alone and making a bunch of mistakes and we're never getting there. It's option A. And maybe you do. Maybe you do get there. Or coming and collaborating inside a community where everybody's doing it together, hand-holding you, literally hand-holding you every step of the way through it. And having access to the mentor who's actively in the deal. We're buying deals. We're in the market every day. And we're going to continue to do it because we want to get to 10,000 units. Where do you want to get to? Where do you want to get to? Is it 10 units, 100 units, 50 units, 200 units? We can help you get there. We can help you get there. We can make it happen.